Hey everyone, welcome back to another episode of Real Estate Shorts. I'm Alex Morkate, and we're going to be picking up where we left off on the three main mortgage metrics used by commercial property lenders to help evaluate their loans. So first we started talking about what those metrics are: debt service coverage, debt yield, and loan to value or loan to cost. We spoke a bit about why they exist. Now I'd like to dive into each one of them individually in a bit more detail to illustrate how they work, how they're calculated, and from the lender's perspective, how they're applied. So we'll start off with debt service coverage. So first and foremost, lender wants to make sure that you are collecting more income than what they are asking you to repay. So again, as a quick example, if you have $120,000 worth of income, they are not going to lend you as much as what that income can support. They're likely going to want you to earn more than what you have to pay in case your earnings change. So the general formula for this is net operating income divided by annual debt service. So we can go into a lot more detail about how NOI is calculated, which NOI they choose, do they make any adjustments, and so on in another video. For now, we'll just take it at face value. NOI divided by debt service. Lenders are always going to be looking for 1 or over, so a ratio of 1.0 or more, and chances are good it's going to be around 1.2 or up. So there are circumstances where they may be willing to accept a little bit less, but I think a lot of that has to do with the source of those revenues. So for example, government subsidized or sponsored housing tend to see lower debt service coverage ratios because the lender is confident in the source of capital and may be receiving other peripheral benefits. And we can talk about banking and reserve requirements and such in another episode. So for now, at least, they may be willing to require less coverage when they feel more comfortable with the source of that income or the quality of that income. Now, I think it'd be important to point out kind of how we got to this process. So it's usually going to be a two-step process. We'll be defining loan terms, so amortization term, interest rate, loan amount. And we can use that to estimate the debt service on a monthly basis and then annualize it to figure out the annual amount of debt service. So in this example, if we have $72,000 worth of net operating income and $57,300 worth of annual debt service, NOI divided by debt service will give us 1.26. Now, I would encourage you to keep the absolute value of debt service in mind. I think showing a negative debt service implies that you don't have enough income to cover the debt service obligation. In this case, that's not true. You have more NOI than you do debt service. So putting a negative in the denominator will help you correct for that, or simply recognizing that you should take the absolute value of the debt service cost and put that in the denominator of this ratio. So next is debt yield. So we can take the exact same example where we have the same loan terms, the same debt service, and our annual NOI. But if you'll notice, in this case, debt yield really ignores the payment altogether. And that's by design. The debt service coverage ratio is meant to include the impact that term and interest rate have on payment. Debt yield isn't about measuring that relationship to payment. It's about measuring the relationship to the loan amount. So its formula is NOI divided by the amount lent, or the maximum amount to be lent in a construction scenario. It's not affected by amortization term. It's not affected by interest rate the same way that debt service coverage ratio is, because they don't even come into play. This is really just a metric to define how much yield or return a lender could come to expect if they lent a certain amount, or how it relates to how much NOI there is on that property. So the lower the risk, the lower the required debt yield. Debt yields are all over the board. Different lenders with different motivations or strategies are going to define the debt yield. So I think, for example, construction lenders on very risky markets or risky asset classes or risky borrowers would push a much higher debt yield. because they'd want to make sure that they could earn an appropriate return relative to the amount of risk that they were taking on. On the other hand, let's say, credit, single tenant, nationally recognized retailer, they may be willing to, a bank or lender may be willing to command or demand a lower debt yield because they don't perceive there to be as much risk in that borrower or that property defaulting on that loan. So in general, I've seen ranges in, call it the low 7s, maybe as much as a high 6%, all the way up north of 10%. And again, I think this really boils down to the relationship that the borrower has, the strength of the borrower, the strength of the collateral, the strength of the income in the tenant and the market, and so on. This is nothing more than another ratio to help banks measure and manage risk. So they'll evaluate risk and they'll come to a determination. There's no hard and fast rule when it comes to debt yield. So just keep in mind, more risk, likely higher debt yield, and vice versa. The last example, or the last metric, is going to be loan to value or loan to cost. So in this case, we have $1 million being requested as a loan, and the property has a value of $1.5 million. So 1 million divided by 1.5 million gives us 67% roughly. So I think the ratio itself is very straightforward. How much are you borrowing relative to how much is the property worth? The only caveat that I'd like to give is when we talk about development or construction, they may not be looking only at land value. The lender may also be considering an as-if valuation. So as if the property was completed, as if the property was fully occupied, as if the property had been operating for 1, 2, or more years. So more lenders are going to be looking at both the as-is value of the land as well as the as-if value based on a certain circumstance to determine how much they'd be willing to lend, and also what they think the collateral value is and the relationship of the two. So I think a great example of this is going to be this construction lender who's willing to give you a certain amount now, so let's say to help you buy the land, and then they'll help you fund more as you go. So with every month that goes by and your construction makes more progress, they'll lend you a bit more, but they're not going to give you all the money up front, because then the loan to value or loan to cost ratio would be out of whack. They would have lent you too much relative to the current value. So just keep in mind that loan to value and loan to cost is a bit more flexible than what this formula may imply as its face value. It's possible that the lender could establish milestones, benchmarks, or strings on how much money they're willing to give you and when. Typical loan to value ratios in commercial real estate are probably between 50 and call it 80, 85%. And I think, again, this varies widely based on one, who the lender is, and two, the borrower and property type. So again, government subsidized housing where the income is secure or the income is kind of backstopped or supported by the government probably makes the lender feel a bit more comfortable because there's more security of that income being paid. On the other hand, raw land that has no source of periodic income may make the lender feel a bit more nervous or uncomfortable about the variety of sources of repayment. So they may be willing to stretch a bit higher on a loan to value on an existing multifamily with government subsidized housing, or much lower on raw land and really everything in between. If you want a good starting point, I would recommend you probably start at about 65%, and then you work your way up or down based on where you are in that risk spectrum from the lender. As always, the more risk, the lower the LTV, and vice versa. So just to recap, banks are probably going to be employing at least two of these three metrics when they evaluate your commercial property. They're going to be taking a look at debt service coverage ratio, debt yield, loan to value, and or loan to cost. They're going to be using these to help qualify the quality of the income and the quality of the collateral so they can get comfortable with how much to lend you. Can you afford it? And if things go poorly, are they going to be secured in the amount that they lend? So as always, if you have any questions, comments, or feedback, I look forward to hearing from you. And if you found this video helpful, I'd recommend you take a look at a handful of others. Thanks again.